Hey everyone, welcome back to the channel. So today I'm going to do a strategy video. Now, with all strategies, there's no one perfect strategy for everybody. Everyone has their own trading ideas, trading styles, trading beliefs, but hopefully this one will be able to give you some encouragement if you're starting out trading, just some ideas of how you actually build on this one and build a real robust, reliable strategy. Now, it would be great to be able to say, just do these 5 simple rules, for example, and every single trade will be a winner. But unfortunately, no strategy is 100% and nothing is perfect. I can give you ideas of how we get into the trades, but as always, there's going to be market conditions come along, news events or anything to just have a real impact on the actual trade itself. So what I'm saying here is just try and be careful when you're actually starting to apply this to your own trading and do a bit of back testing, a bit of research and how you can tweak it to try and make it work for you. Now, I've been using this strategy for years. It's varied slightly over time, but I'm going to go back to the basic principles of when I first learned it or read about it and build on it from there. Now, essentially, it's a trend following strategy and waiting for a pullback into a zone where we can actually get back in and price goes back with momentum. So as we know with trends, we're looking for higher highs and higher lows if we're in an uptrend and lower lows and lower highs in a downtrend. If you're able to define those, and also get confirmation that we're in a right trend by looking at a higher time frame, that gives extra confirmation this is going to work. Because going with the momentum, with the trend, with the crowd, there's more people behind us and therefore more likely that the price will go in the direction we are predicting. If we're trying to go counter trend, there's always that risk that we could just end up going completely against the grain and just get wiped out very quickly. So because we're working on a trend and momentum, this can work on any particular instrument we want to trade, whether it's forex, indices, commodities, or even cryptocurrency to that matter. All we're doing is waiting for price to surge, get to a new high, pull back into an area where we think it's going to react, whether it's to moving averages or that they're going to get reaction from a previous low or previous high, and then bounce, take out into our order, and therefore carry that momentum all the way back up to hitting our take profit point or even trading our stop and letting it run for a long period of time. So let's take a quick look at how the actual strategy works, what the setup is, where we put our stop loss and our entry points, and how we can possibly tailor this going forward. So I really hope you can see the potential in this strategy. Now, the examples I have shown on the particular charts here do actually work. They have in real world would have hit their targets, but as always, that's one particular example. If I pulled out different charts from different time periods or time zones, things may not have worked. That's why we start to tailor this for ourselves, use a bit of common sense, look at how the bars are reacting, how price is moving at a particular time, and then we can actually tailor that to actually get into the trades and make them more successful and more profitable. So first off, really want to define what a trend is and what it looks like. Now, a lot of people want to try and draw a perfect trend line and join up all of the lows, for example. In a real world, that doesn't quite work, but as long as we can see on the charts, we've got higher highs and higher lows if we're in an uptrend, or lower lows and lower highs in a downtrend, and we can draw these points in on the actual chart itself, we can confirm we have an uptrend, and providing prices going upwards, we're looking with the momentum to going that way as well. So when we look at the chart itself, we're actually trying to confirm that price is moving higher, so making new highs, and by looking at the charts, we'll see a succession of buyer or green bars and prices moving higher and higher. So once prices pull back, we're really looking for 2 consecutive seller bars in an uptrend or buyer bars in a downtrend. The reverse is exactly the same. So here we've got 2 red candles in our price action, which confirms that we've now got a bit of a sell-off. The sellers have taken a bit of control, but ultimately because we're in an uptrend and that's been confirmed, we know the buyers will come back in at some point very soon and push price higher. We also want to try and make sure that the close of that second bar is below the low of the previous bar. Again, it just shows that the momentum has been pushing downwards and therefore we're in a good position that we're actually going to get a bounce. So once we've confirmed that, what we're going to do is set an order. We'll put our buy order just above the high of the previous candle and the stop loss just below the low. So if we're on Forex, we're looking at say 1 pip, and if we're on indices, let's say 1 point. So from this point, there's 2 options can happen. We either have the buyers come back into the market, it goes through our order, it triggers this into a buy, and therefore we're good to go, and price continues on where we need it to be. Or the sellers are still not quite finished with this one, and we get another bar going downwards, but because we haven't triggered our actual order itself, that's fine. We can actually have a good to cancel or a time limit on the order itself. Therefore, at this particular bar, we can actually have it expiring anyway. So price has fallen, but it's not triggered our buy order. But if our conditions are still met for actual our entry point, so if actually the low is below the close of the previous bar, all we do is adjust our order down to where actually are on this previous bar. So all we're doing is moving our order level to the high of the previous bar, and again the stop loss below the low. Now, if this was a massive bar, let's for example, I wouldn't be looking to take this particular trade. If the bar was a bit smaller, then fantastic, it gives us much better risk management and a better way of getting to the trade and getting more momentum going forward. We also want to make sure that the actual price of the current price hasn't broken down through the previous low, and therefore we're still in an uptrend. So in this example, the buyers have come back into the market, price has gone upwards, it's now triggered our order, and we're actually now into a live trade, and from this point we can start managing it going forward. What we don't want to do is get too excited. As we know, price goes up, price goes down. In this example, we could just see a price pullback slightly. It could actually come back into our below our entry point, actually be in a slight loss for a small period of time. But again, it's nothing to worry about because we have our stop loss in place, our risk management in there, and we haven't risked any more than the actual percentage we're looking to risk on any one trade. And because we know we've got confirmation with the momentum in the main direction, we've looked at a higher time frame as well to confirm we're actually going upwards. We know the momentum is with the actual trade, buyers come back in, price surges up, and we're now back in profit. And at this point, we're just waiting and watching and seeing what price does. Again, not getting too scared by the actual price and moving our stop loss too early. Now, if after the third bar, for example, we're actually still in a profit, we can actually start moving our stop loss, trailing it below the actual low of the previous bar. And we can keep doing that if we want to, keep trailing our stop loss up, either to get to break even or into a small profit. So you can either trade your stop loss, or you can actually wait until you hit a take profit or a point where you're able to just close out the trade. If you want to get a 2-to-1, 3-to-1 R2R, then you can obviously have that set, or you can use the previous high as example as an area where it's going to hit and carry on that momentum. And as always with trades, although the price goes up, it may pull back slightly. Again, we've got our stop loss in place to make sure we're not risking too much. And eventually the price comes back in, it hits our take profit, we've got to a new high. At that point we can close the trade out and bank our profits. And as always, we want our trades to be as profitable as possible and be as accurate as possible. So there's lots more things we can consider around the entry and managing of the trade just to make sure we are in the best possible position to maximize our profits. So for example, we can look at a higher time frame from where we're actually going to our entry point to confirm that is the direction and momentum the actual overall trend is going. So for example, if we're on a 15-minute chart, we can look to the 1-hour chart to get confirmation that's the direction. If you want to trade off a 4-hour chart, look at a daily chart for our overall trend. We can look at some momentum indicators to really give us some confirmation that the price is moving with us. For example, if we are using the RSI in our trades and our setups, then if price is above 50, we are into a buyer's zone. Provided it hasn't got overextended above 70, we're in a good position to assume that the momentum will continue. Again, if we are selling, we want to be below 50 and not below 30. ADX is another very good indicator for showing trend and the strength of a trend. Now, if we're looking for ADX example, anything above 25 is showing a good strong trend and likely to continue. We can also look at stochastics and MACD for convergence. If we're seeing convergence on the indicator itself against price, we can also know that there's going to be a continuation of the price. Likely if we see divergence, we're looking to see price reverse. We can add moving averages to our chart. So if price is above the 50 moving average, as an example, we're looking for buys, or if price is below, we're looking for sells. We're just confirming on the moving average that that's a direction that we're looking to take trends. And again, as always, make sure there's no news events coming out around the time of placing trades. If we're on a daily chart, I'm not too worried. If we're down to the 5-minute or the 15-minute chart, really look forward to the sort of next hour where a news event could actually come and have a catastrophic effect on our trade itself. So here's a few real-world examples of how this would work on the US 30, so the Dow Jones, and this is based on a 4-hour chart. Just a very, very quick scan through the price to see where it actually would have been a winning trade. So we can see in this situation here, price has been rallying up quite nicely. We've got a load of green bars showing that the actual buyers are in control. And as we get to breaking out to a new high, price starts to pull back. And then after 4 of these bars, we can see the close is below the low of the previous bar. So if that was to be our entry point, We've set our order just above the high, our stop loss just below the low. Now, although this next candle does actually break through our stop loss, I'm assuming that that was actually after the previous bar, price came down and then broke up to actually take our trigger rather than being the reverse. So here I'm assuming we actually were in the trade. So this next example is quite interesting because the previous few bars were actually almost rejection of the price at that level, and therefore we could have actually assumed that anything breaking below that point would have been a confirmation into a reversal. But because we've got the bar closing below the low, for me that was quite a large bar. I may have not taken that trade compared to the other ones, but looking at the bars previous, we can see that they themselves were actually a rejection of that price, and therefore price were more likely to go in our direction. And as we can see, price did break out through the entry point and got very, very quickly to a profit. We could have made easily a 1.5 return on that first one. Price came back down. Again, no point did it come close to our stop loss. It bounced off where we actually were breaking out originally and came all the way back up. So even if we were trailing our stop loss, we could have got locked in some good profits, or just let it run for a long period of time and got even more. Again, our final example doesn't quite meet all of the rules of the actual bar closing below the low of the previous bar, but what I like about this one is actually the bar is a lot smaller than the previous one, and therefore there appears to be less sellers in the market at that point pushing the price down. So again, as we can see, price literally bounces off the 20 moving average, it comes just above that, price breaks up straight away and just continues in a massive momentum higher. So if you want to see some more strategy videos, let me know in the comments down below and I will do some more research, I will back test them and come back with some more fantastic results. But as always, I'll see you all again next video. Cheers everyone.